Gold and silver just did something that has never happened before. Not in this decade, not in the last commodity supercycle, not even in the years following 1971, when the world cut its final tie to the gold standard. Something changed. Quietly. Almost unnoticed by the general public. But inside central banks, inside trading desks, inside the offices of the people who move billions of dollars a day, the signal has already been received. And by the end of this video, the audience will understand exactly what that signal means, who is already positioning for it, and why the next 12 months may decide who protects their wealth, and who does not. Welcome back to Precious Metals Intelligence, the channel built for those who prefer to understand markets before they move, not after. Before continuing, it would be genuinely appreciated to know where in the world this video finds you today. Please share your city or country in the comments below. This channel has viewers across nearly every continent, and it is always meaningful to see just how far this conversation on wealth and economic history reaches. For most of human history, gold and silver were money, not a backup to money, not an investment. They were the actual currency that people used to buy bread, land, and safety. That changed in 1971 when the United States broke the last official link between the dollar and gold. Since that year, the world has been running on an experiment. Every dollar, euro, and yen in existence today is backed by nothing but trust. No metal, no fixed value, just a promise from a government. 54 years is a long time in a person's life, but in the history of money, it is barely a moment. For thousands of years before 1971, gold and silver held their place as the foundation of wealth. The fiat system the world lives under today is still, in historical terms, young and untested. And a growing number of serious financial voices now believe that this experiment is entering its final stretch. One of those voices belongs to a man who spent years running commodity research at Goldman Sachs, one of the most powerful financial institutions on earth. His job was not to guess where markets might go. His job was to study money flows at a scale most people will never witness. And recently, he said something that should make any careful investor pause. He explained that the world does not need central banks to hold a formal meeting and announce a return to the gold standard. That idea, he said, misses how the real world actually works. Central banks will never wake up one morning and declare that gold is money again. They do not need to, because the price of gold will quietly do that work for them. Here is how the mechanism functions. Every central bank on earth holds a mix of reserves. Some of that mix is gold, some is foreign currency, some is government debt. When the price of gold rises, the value of the gold portion of those reserves rises with it, even though the physical amount of gold has not changed. This means that without buying a single new ounce, a central bank's gold holdings become a larger share of its total reserves, simply because the price went up. Now imagine this happening across many countries at once, as gold prices climb higher and higher. Some central banks will suddenly find that their gold reserves have grown far larger in value than their peers. Other central banks, the ones holding very little gold, will look increasingly underweight and unprepared by comparison. That gap creates pressure. It creates a kind of quiet competition. Nations that are behind will feel compelled to buy more gold, simply to keep their reserves in line with everyone else. This is the part that makes the idea so powerful. It does not require a treaty. It does not require a vote at the United Nations. It does not require any government to admit that the fiat system has failed. All it requires is a rising gold price. The market does the persuading. The result looks the same as a return to the gold standard, even though no formal announcement was ever made. There's another force adding pressure to this cycle. Many major economies, including the United States, are dealing with growing government debt and rising interest costs. When a government's fiscal situation becomes large enough, it starts to influence decisions that are supposed to be independent, including decisions made by central banks. This condition is sometimes called fiscal dominance. In simple terms, it means the size of the debt begins to steer monetary policy rather than policy steering the debt. When fiscal pressure grows and currencies come under strain, gold has historically become the asset that governments and investors trust when paper promises start to look shakier. That is not a new idea. It is one of the oldest patterns in financial history. What is new is the scale at which it may be happening right now and how quietly the shift has already begun. This is the foundation of the entire story. A slow, mathematical, almost invisible process, driven by nothing more dramatic than price itself, may be pulling gold back toward the center of the global financial system. No dramatic press conference, no official policy change. Just a number on a screen, rising higher and forcing decisions behind closed doors that most of the public will never see. And the number some serious analysts believe gold is heading toward next is far higher than most people expect. Numbers can feel abstract until someone attaches a real figure to them. And when a former head of commodity research at Goldman Sachs puts a number on gold, people tend to listen, even when that number sounds almost impossible to believe. The number he gave was $10,000 per ounce. Not $5,000, not $7,000, $10,000 for a single ounce of gold. Alongside that, he placed a second figure for silver at $300 per ounce. To put that in perspective, gold has traded for a long stretch of recent history somewhere between $1,800 and just above $4,000. Silver, for most of the last several years, moved in a range far below $100. A jump to $10,000 and $300 would not be a small move. It would be a complete transformation of how these two metals are priced and understood. When numbers this large are mentioned, the natural reaction is disbelief. Many people hear a figure like $10,000 gold and assume the person saying it has lost touch with reality. But history tells a more careful story. Every major commodity supercycle in the past has produced price levels that seemed absurd right up until they happened. In the 1970s, gold moved from around $35 to over $800 in less than a decade. At the start of that decade, a figure like $800 would have sounded just as unrealistic as $10,000 sounds today. People who lived through that era remember how quickly disbelief turned into acceptance and then into regret for those who waited too long to act. This is why serious analysts pay attention to supercycle patterns rather than dismissing large numbers outright. A supercycle is not a short-term spike. It is a long, sustained shift in the value of a resource, driven by deep structural forces rather than short-term speculation. And when someone with decades of experience inside one of the world's most influential financial institutions raises a number like this, the responsible approach is not laughter. It is investigation. Behind these numbers sits a deeper and more uncomfortable concept. It is called fiscal dominance, and it is not something typically discussed in casual conversation, yet it may be one of the most important forces shaping the next decade of financial history. In a healthy economic system, a central bank is supposed to operate independently. It raises or lowers interest rates based on inflation and employment, without worrying about how those decisions affect the government's ability to pay its own debts. But when a government's debt becomes large enough, this independence starts to break down. Raising interest rates too high can make it far more expensive for the government to service its existing debt. At a certain point, the size of the debt itself begins to limit what the central bank can safely do. This condition, where fiscal pressure overrides monetary independence, is fiscal dominance. Many economists believe the United States is now operating inside this exact condition. This backdrop makes the timing of the upcoming Jackson Hole speech far more significant than a routine economic update. Each year, central bank leaders gather in Jackson Hole, Wyoming, to discuss the direction of monetary policy. Markets around the world watch closely because these speeches have at times shifted the direction of gold and silver prices for months or even years afterward. This year, the speech carries extra weight because the person delivering it is new to the role and has so far given very little indication of his true position on inflation and interest rates. If the speech leans toward a tone that appears more cautious about aggressive action, many analysts believe it could support continued strength in gold and silver. If it leans hawkish, suggesting a strong stance against inflation regardless of economic pain, it could introduce short-term uncertainty. Nobody outside a very small circle knows for certain which direction the speech will take. That uncertainty itself is part of the story. Markets do not like unanswered questions, and this speech represents one of the largest unanswered questions of the year. What connects all of this together is simple: a structural shift in how gold is valued, a fiscal condition that limits how central banks can respond to it, and a single speech arriving at a moment when the entire system appears to be listening for any sign of what comes next. The next part of this story moves away from central banks and government debt and into something far more physical: a silent industrial demand for silver that few people realize even exists, and a corporate ambition so large it could reshape how much silver the world actually needs. While gold carries the weight of history and monetary trust, silver has been quietly fighting a different kind of battle, one that has almost nothing to do with vaults or central banks. This battle is industrial, and it explains why silver may behave very differently from gold in the years ahead. For most of the 20th century, silver had a clear identity problem. It was seen as gold's smaller, less important cousin. Investors bought it because it was cheaper than gold, not because it had its own independent story. That perception has now changed in a way that surprises even people who follow markets closely. In recent years, the United States government added silver to its official list of critical minerals. This designation is not symbolic. It is reserved for materials considered essential to national security and modern technology. Silver earned that place because of one simple fact: no other metal on Earth conducts electricity as efficiently. That single property, superior electrical conductivity, has quietly made silver essential to some of the fastest growing industries in the modern economy. Solar energy is one of the clearest examples. Every solar panel produced today requires silver to carry the electrical current generated when sunlight strikes its surface. There is currently no widely available substitute, that performs the same function at the same level of efficiency. To understand how large this demand could become, consider the ambitions of major companies now entering large-scale solar production. One well-known company, along with a related aerospace venture, has stated a combined goal of producing 100 gigawatts of solar capacity every year inside the United States. That is an enormous scale of production. Based on the average amount of silver required per gigawatt of solar capacity, a build-out at that size could require somewhere close to 70 million ounces of silver annually just from this single effort. To place that in context, 70 million ounces would represent close to 10% of all the silver mined in the entire world each year. And this estimate covers only one initiative in one country inside one growing industry. Solar is not acting alone. Artificial intelligence infrastructure has also emerged as a meaningful new source of silver demand, as the physical hardware behind AI systems relies on silver for its conductive properties as well. When solar energy demand and AI-related demand are considered together, some estimates suggest a combined call on silver reaching well over 100 million ounces per year from these two sources alone. History offers an important lesson here, one that shows silver's ability to survive even severe disruption. In the year 1999, silver demand from photography alone reached roughly 250 million ounces per year. Photographic film at that time was one of the largest single uses of silver on the planet. Then came the digital camera, followed by the smartphone. Within 2 decades, photographic demand for silver collapsed by nearly 90%, falling to only about 34 million ounces by the year 2019. On paper, this should have been a devastating blow to silver's industrial relevance. It was not. Despite losing almost its entire photographic demand base, total global silver demand did not collapse alongside it. Instead, overall demand actually grew, rising by roughly 1/3 between the year 2000 and the year 2020. New industries, from electronics to medical equipment to renewable energy, absorbed the gap left behind by photography and then expanded well beyond it. This pattern reveals something important about silver that many casual observers miss. It does not depend on any single industry to remain valuable. When one use fades, another almost always appears to take its place, often at a larger scale than before. This creates an unusual and somewhat paradoxical situation for the metal today. Manufacturers are actively working to reduce the amount of silver used in each individual solar panel and each electronic device in order to lower costs. Yet even as the amount used per unit shrinks, total global demand keeps climbing because the number of units being produced is expanding even faster than efficiency can improve. This is the quiet industrial reality sitting underneath silver's more famous identity as a monetary metal. It is being pulled in 2 directions at once, valued by investors seeking protection from currency instability and consumed at an accelerating pace by industries that have no substitute for what it does. Very few metals in the world occupy both roles at the same time, and even fewer occupy both roles at a moment when global supply is already considered tight. While much of the Western financial world debates whether gold and silver deserve a larger place in modern portfolios, another part of the world has already moved past the debate stage and into action. According to reporting from Bloomberg, China has been quietly constructing a global network of gold vaults positioned in strategic financial centers, including Hong Kong. The stated purpose of this network is to support the international use of the yuan, China's currency, by allowing trades conducted in yuan to be backed or anchored directly to physical gold. This detail deserves careful attention. If a country's goal were simply to promote its currency for everyday trade, building physical gold vaults would not be an obvious first step. Currencies can be promoted through trade agreements, banking partnerships, and digital payment systems. Gold vaults suggest something different. They suggest an effort to give a currency a form of backing that outside partners can trust, even if that backing is not formally announced as a return to any gold standard. This lines up closely with the same underlying idea explored in Part 1, where price and structure quietly do the work that political declarations do not. This move did not happen in isolation. In 2025, the Chinese government officially reclassified gold as a strategic mineral. That designation places gold in the same category of national importance as materials tied directly to energy, defense, and advanced technology. A government does not typically apply that label to an asset it views as a simple investment option for its citizens. Strategic classification signals long-term national planning, not short-term financial trend following. Alongside these government-level actions, there's a demographic and cultural dimension that is easy to overlook, but difficult to ignore once explained. China and India together are home to roughly 2.8 billion people, nearly 10 times the population of the United States. In both nations, gold and silver hold deep cultural significance that extends far beyond investment portfolios. They are tied to weddings, family savings, religious practices, and generational wealth transfer. This is demand that does not rise and fall with quarterly earnings reports or short-term interest rate changes. It is structural, embedded in daily life, and has persisted for centuries. When government-level strategy and long-standing cultural demand move in the same direction at the same time, the effect is not simply additive, it becomes reinforcing. Government gold purchases support price stability and long-term confidence. Cultural demand provides a steady, reliable base of consumption that does not disappear during periods of market uncertainty. Together, these two forces create a foundation for gold and silver demand that many Western investors have not fully priced into their expectations. This is perhaps the most important point in the entire story so far. The shift described in Part 1, where rising gold prices quietly force a reordering of global reserves, is not a theoretical future event. It is already being built, brick by brick, vault by vault, inside one of the largest economies on the planet. While financial commentary in the West often frames gold as a defensive asset, something to hold during moments of fear, China's approach appears far more deliberate. It resembles long-term infrastructure planning, not short-term hedging. For the individual investor watching from outside these decisions, the implication is direct and worth sitting with. Major economic powers do not typically announce their long-term strategies in advance. They build the infrastructure first, quietly, and allow the world to notice only after the foundation is already in place. By the time a shift like this becomes obvious to the general public, the earliest and most significant advantages have often already been claimed by those who were paying attention early. This raises the central question the final part of this story must answer. If institutions, governments, and central banks are already positioning around gold and silver at this scale, what should an individual, watching from home, working a career and planning for retirement or family security, actually do with this information? The final part of this story brings every thread together, from price mechanics to fiscal pressure to industrial demand to geopolitical strategy, and closes with the forward-looking cycle forecasts that tie the entire warning into a single, coherent conclusion.